joining me today in our course OAF 101, the Principles of Accounting. And my name is Mang'ana. I'm an assistant lecturer from the Open University of Tanzania, Faculty of Business Management, Department of Accounting and Finance. Basically, we're going to look at something new. It is so-called the preparation of financial statements. So today, we are going to look at financial statement. Preparation of financial statement. This is what we are going to look today, okay? So basically, one should ask, what do we mean by financial statement? Or what comes into your mind when you hear someone saying financial statement? Financial statement is summaries of financial records in form of statements, whereby users of financial information may be able to understand what is in it, or may be able to understand the operations, performance, and activities of a particular company or a given organizations in terms of these financial reports. Now, to start with, one should ask how many financial statements or how many reports that we mean by financial statements. With the standards, we have almost like 5 financial reports or financial statements. One, we have the balance sheet, the income statement, statement of cash flows, statement of changes of equity, and notes to account. The former two that I mentioned, the income statement, balance sheet, recently we are not used to call them the balance sheet and income statement. The used name for balance sheet, it is the statement of financial position, and the used name for income statement, it is the statement of financial performance. Okay. So basically, what we are going to do is we are going to see how you have to go about into coming up with a financial statement, the preparation of financial statement. That is our main concern today. We are going to see how you can go about into preparing the financial statements. Remember, in our previous lecture, we went through the elementary process from the accounting cycle, whereby you're supposed to journalize, the process of journalizing. Then you come to the posting, you post the journal entries, you transfer the records from the journal entries to the ledger, and then after the ledger you post to the trial balance. That is where you come to the preparation of final accounts or financial statements. Okay. Now we saw how you can transfer from the ledger to the trial balance, the closing balance of the ledger accounts to the trial balance. Then the trial balance is used to prepare the financial statements. Now let us start with an understanding why do we need to prepare financial statements. Why do we need to prepare financial statements? Okay. Why do we need to prepare financial statements? Why do we need to prepare financial statements? Okay. You see, these financial statements gives, as I've said, gives information whereby a number of users need these financial statements. These users, it depends. We have external users and internal users. External users, they're the ones. For example, we have investors. Investors are those people who invested money into the company. So through the use of financial statements, they expect to see the prospect of their investment. And for example, from the income statement or the statement of financial performance, they can be able to anticipate if the company is performing better or not, or even they can be able to see probably if they can get dividend in the end or how much has been attributed to dividend and so forth. Even the rise and fall of their shares, you can even see from the financial records. But again, from the internal view, we have employees. Employees also sometimes have to have a look into the financial statements. Why? Because these are users, employees, because these they have a stake into a company, so they will be able. They want to see if a company is able to pay or to meet their personal due. For example, if the company is able to meet, or if the company is able to pay them salary in a near future time, or probably in the forthcoming year. So they want to see, but you can even see if the company is performing better or not, so that you can anticipate the going concern, or sometimes even you can anticipate the credibility or liquidity of a company. Again, I've just mentioned of the investors or the owners, this being an external one and this is an internal one. But we have a number of users. We even have creditors. Creditors, they will want to see the credit worthiness of your company, so that they can be able even to continue supplying you goods in credit or not, or even if you're indebted with them, the creditors will want to see if you will be able to pay them. For example, from the ratios that if you analyze, if you go into an analysis of your financial statement, for example, into the ratios of liquidity, so they want to see how liquid your company is. So our intention today is not into discussion of the uses of financial information, but as I've said, our intention here is to learn the preparation of financial statements. And I'm just trying to remind you, and I think I have also to remind you of the accounting cycle, as I've said, accounting cycle. That you have here you have the journal entries, or the journalizing process. Then you come to the posting, and posting we mean the ledger posting, and then here you have the trial balance, and then from the trial balance you have the final accounts, and here it is whereby you prepare the financial statements, financial statements. So today we will concentrate here, because we have gone through the trial balance, and we've gone through the posting to the ledgers, and I am certain sure that we know how to deal with the journal entries, okay? And we are confident with the accounting, the basics into the debit and credit and other aspects that we have captured in our previous lecture, okay? So to start with, let me mention again these financial statements that we are having. I've said that we have almost 5 of them. We have the balance sheet. I am repeating this so that you can capture them into your mind. You have the income statement. I'm using the old names because most of you, you're very familiar, and you are still using these former names: balance sheet, income statement. Of course, probably soon you'll be able to capture the new names. Like I've said, balance sheet is the statement of financial position, income statement, statement of financial performance. You have the statement of cash flow or cash flow statement, and you have also statement of changes of equity. I'm shortening it, changes in equity. I'm trying to shorten it. And then you have notes to account. So let us start with the balance sheet. Okay? Let us start with the balance sheet. Now the balance sheet. The balance sheet, it contains elements that you can find them in the accounting cycle. Now the balance sheet contains now the balance sheet contains elements from the accounting equation, that we have the assets, liability, and capital. So when we talk of the balance sheet or the statement of financial position, be sure that you're going to get 3 elements out of them. You're going to have the assets here in it, then the liabilities, and the owner's equity or the capital. Let me shorten it by saying capital. So you have assets, liability, and capital. So these are the elements that you expect to get them from the balance sheet. Now assets have been categorized into two groups. We have long-term assets or fixed asset, or we call them non-current assets, and we have also current assets. So here we have non-current assets, and then we have current assets. CA stands for current asset and non-current asset. Likewise with the liabilities, we're going to have long-term liabilities and non-current long-term, which is the same as non-current liabilities and current liabilities. And lastly, we have the capital. Okay, so these are the elements that you expect to have them into your statement of financial position or the balance sheet. Now, what do we mean by assets? Assets are items of value that are owned by your business. Okay, all those items of value that you expect your business owns them. But liability, and again, we all know that liability, for example, when you have a loan from a bank, or when you have creditors, you might be given even a loan from a creditor. Sometimes when a creditor is supplying you goods and credit, or is giving you loan, or sometimes when a creditor is giving things in advance, it is still a liability to you because you have to pay them. Of course, we know what it means by capitals. It is equally the same as owner's equity. Okay. So now let me also give you a format. Now this is the format. This is the format of a balance sheet. You have to start with an assets. But we have non-current asset and current assets here. So you have to put non-current asset items. For example, the buildings, all the fixed asset buildings, land, fixtures and fittings. Then here, you'll have to have the total of non-current asset and the total of current asset. By current asset, we have cash equivalent, we have debtors, all the prepayments, and other elements that falls under the classification of the current asset. Okay. Then after that here, the totals of your assets should be equals to liabilities and capital. Again, liability, you're going to have non-current liabilities and non-current liabilities and also current liabilities. You still do the same so that you have the totals here. Then then lastly, you're going to have your capital. So the total of your liabilities and capital should be equal here, should be equal to the totals of the asset. So basically, this is an elementary form of how your statement of financial position should be on a balance sheet. Okay. Yeah, that is very simple. And also, let me come to another statement saying I'm using the former names, the income statement. Currently, this is known as the statement of financial performance. It is also known as statement of financial performance. It is also known as statement of financial performance. So when you hear someone is telling you to prepare for statement of financial performance, actually is telling you to prepare the income statement. Okay. So you have to note that statement of financial performance, it is equally the same as income statement, because the profit or loss, it is an indicator of whether you're performing better or you're not performing better. Now again, with the income statement, expect that you're going to have sales or revenue. So here you're going to have element of revenue. Simply, and a simple elementary form is when you have revenue and expenses. So you're going to have your revenue here, and then you less expenses. You're going to have either a profit or you're going to have a loss. That is a simple one, but again, I expect you, because this is the principles of accounting, you're getting older in terms of knowledge, and this is like a milk to a baby. So out of the income statement, part of it, you have a trading account, and then the trading account, it is showing all elemental activities that will give you, in the end, will give you the gross profit or gross loss of activities that have been done under the trading environment. And then the gross profit, if you less operational expenses, it is where you're going to have a net income or or if you are going to have a loss, that is a net loss. So this is the format. I expect, for example, if you are in a mechanizing or whatever the case, I expect that you're going to have your sales. So sales, sometimes it is equally the same as revenue. Okay, so this is your sales, and then out of your sales, you have to less cost of sales. Cost of sales. Cost of sales. Now, cost of sales, under cost of sales, here you'll have your opening balance or opening stock, because I expect that you're going to sell stock. So you're going to have your opening stock here. From your opening stock, you add purchases. If you purchases new items, then so you have your opening stock, the stock that was at your disposal when before you had the sales at the opening at the opening balance, and then the totals from the opening stock, and you add purchases, you're going to less the closing stock, from the totals of the purchases, new purchases in the opening stock, and then the difference, when you less this one, the difference, it is the amount that we call it the closing balance or the cost of sales. Okay, so I repeat here to make it clear. What we are trying to look here down here, we are trying to find a figure that will actually mean the cost of sales, or sometimes it is also referred the cost of goods sold. I repeat again, cost of sales, it is also referred to as cost of goods sold. Okay, so if you take your sales, you minus the cost of sales, or if you take your sales and minus cost of goods sold, I'm putting the minus here, the brackets, which means the brackets also refer, or these brackets, they still mean the same as you less this figure or this amount from the above. So what you're going to get, if you take the sales, you minus the cost of sales, you're going to get the gross profit. If the figure is if that figure is going to be positive, then this is your gross profit. If that figure is positive, then this is gross profit. But if this figure is going to be negative, then this is not going to be a gross profit, rather than a gross loss. Okay. Now you see what we've done here. From sales, you less cost of sales, whereby you have opening stock, you have added purchases, and then you've less the closing stock, and you ended up with a profit or a loss. This is what we call the trading account, or the trading statement. So what we've done here, it is purely trading. So here you have prepared a trading account. Okay, I want you to note this, because you might be even asked to prepare a trading account. So you come up with this process up to the gross profit. Okay, but that's not the end of the income statement, because my blackboard is not that much long. So you are supposed to go down here from the gross profit. Now I show you how you make a gross profit. Now the gross profit, I show this is a gross profit. Now you have a gross profit figure. You are going to write operational expenses. You're going to less operational expenses. For example, expenses like rent, or if you're going to pay your salaries, okay, or if you're going to be paying your bills, for example, the bills for electricity, utility bill, electricity, whatever operational expenses. If you less these operational expenses from the gross profit, what you're going to get here, it is a net profit if this figure is going to be positive, or a net loss if this figure is going to be negative. So if you go through that process until this point, it is whereby you ended up with a statement that is called the income statement. Okay, I hope now you're clear with it. Now with our course OAF 1-on-1, as I've said that we have a number of financial statements, but our focus here with our course is only to come up with two statements. I want you in the end of this course to be able to prepare the balance sheet and the income statement. So that is our focus today, and we're going to concentrate on it. And to make it clear, I'm going to use an example. You'll see this example coming up in your screen. And then we are going to use that example to solve and to see through the process on how to prepare the balance sheet and then on how to prepare the income statement. Okay. Now from the example that we're going to use here, it's when you are given you're given a trial balance with a list of balances from the ledger accounts. And then from that trial balance that you're given, you're supposed to prepare the income statement, and then you're also supposed to prepare the balance sheet. And this is the rule: before preparing the balance sheet, you have to prepare the income statement, because the profit or loss, it is also going to be incorporated or to be used into preparation of the balance sheet. Okay, and okay, at the end of the question there, you have a note whereby it says the closing stock. It has been valued at an amount of 1,380,000. That is the closing balance. The requirement of the question: you are supposed to prepare an income statement, and you're also supposed to prepare a balance sheet. You're also supposed to prepare a balance sheet. Okay. Now, the information that you are given from the question, the information that you are given here, you're saying Mang'ana traders extracted the trial balance at the end of the accounting period on 31st March 2019. You are requested to prepare the income statement for the year ended and the balance sheet for the year ended 31st March 2019. That was the requirement of the question. Now let us start with an income statement. Let us start with an income statement here. Let us start with an income statement. Okay. Now there are also very important elements before you prepare an income statement. First, here you have to write the name of the company, and our company is Mang'ana Trader. So here you're going to write Mang'ana Trader, and the nature of the statement, type of the accounting or financial statement. This is the income statement or statement of financial position. Then you can say the income statement. Income statement is at 31st March 2019. Then you underline there. So let us start with because you're starting with an income statement. Okay, let us start with the data that we're having. From our format, then you're supposed to have our sales, you list cost of sales, and the cost of sales, you have opening stock, you add purchases, you list closing stock, and then the figure is the cost of sales or cost of goods sold. Out of the sales, if you minus cost of goods sold, you're going to get the gross profit, and then from the gross profit, if you less the expenses, finally you're going to have your profit or loss, and that is the end of the income statement. Okay. Now let us start. Let us go into our figures. If you go into the trial balance, yeah, you can analyze there. You have your sales. Go and find your sales. You have your sales there. How much your sales there? It is 5,150,000. So to make it simple, I'm going to leave behind those. Three zeros. So I'm going to shorten those figures, and I'm going to write our sales there. It is 5,150,000. So it is 5,150. That is your sales. Okay. I hope that you can see that. Just simplify it from the question. Then from the question, then you're supposed to list the cost of sales. Cost of sales. Okay. Now, cost of sales. Okay, from the cost of sales, we have to start with the opening stock. Now, if you don't have the opening stock, then you're not going to have anything. If you go through it, you can observe that we don't have the opening stock, but we were given the closing stock. So our opening stock here is 0. We don't have to write it. It is waste of resources. And then you have to add purchases. So we have purchases. We have purchases there. How much our purchases? Our purchases are 5,500,000. So let us put 5,500. Okay, that was purchase. Or you can even write, if you want to have opening stock, you can say just opening balance or opening stock. But here our figure is 0 because we don't have anything. You can even just put 0. Okay, but otherwise here you don't have to write anything. You add purchases. Then after adding purchases, you list the closing stock. Closing stock. Then our closing stock, we have our closing stock. If you go through the note there, our closing stock, we are told that our closing stock is 1,380,000. So I'm going to shorten it here. 1,380, but actually this represent 1,380,000. So okay, now I'm going to less it here from our purchases. If you less 5,500, if you less 5,500 from 1,380, you are going to get a figure there. So actually, if you less here, you're going to get how much you're going to get here. This is 20. It's going to be it is going to be 4,120, because this is 0, it is 2, you get 1, so this is the figure. Now you're going to less it because here we are supposed to less sales from the cost of sales. If you less 5,150 from 4,120, you're going to get 1,030. So this is your gross profit. This is your gross profit, because that figure is positive. So if you take your sales, you minus cost of sales or cost of goods sold, you are going to get 1,030. That is your gross profit. Now this process, as I've said, the process that you go through from the sales to the gross profit, it is called, or the statement that you have produced up to this point, it is called the trading account. Okay, now you can observe all the process again, and then from the gross profit, if you less the expenses, it is whereby you are going to, if you less for expenses, it is whereby you finalize your statement by having your income statement or statement of financial performance. And by expenses here, we mean the operational expenses. Okay, I'm going to put this figure here above. As I've said, my blackboard is not that much big to be able to show you everything. So I have my gross profit here of 1,030. Then I'm going to less expenses, operational expenses, and these operational expenses, as I've said, expenses like if you have rent, electricity, sort of utility, if you're going to pay your salaries and so forth. Okay. Now let us go again into our trial balance that we were given. If you analyze the expenses that we're having, you will analyze there you have stationaries. So stationaries, how much was the stationaries there? The amount of stationery was 15. That was 15. And then you also have another expenses of cleaning. How much is the expenses there? It's 40. Okay. You have another expenses there where you have lightening expenses and heating. How much you are having? You have 35. You also have motor vehicle expenses. That was 52. For example, the expenses, motor vehicle expenses include expenses like fueling and so forth. So you have to put them as operational expenses. And you have any other expenses? If you go through your trial balance again, no, you don't have other expenses. So you have to add all these expenses. If you add these expenses, 10 to this is 2, you're going to get how much? You're going to get 442. Okay. So these are expenses. Total of your expenses is 142. So if you take a gross profit of 1,030, if you minus 142, you're going to get 888. So this is your net profit. This is your net profit. Now, if you reach to this point, it is whereby you're saying you have a full income statement, whereby you've came along from the gross profit to the cost of gross profit, but before from the sales minus the less of your less cost of sales, then you have your gross profit less expenses, operational expenses, you have your net profit. So this is the format of the income statement. You see, it is as simple as that way. Very, very simple, and I hope you are able, or you've been able to understand it well. Okay, that was part one. That you were required to come up with the income statement. Okay. Now let us use the same figures to come up with another statement, which is the balance sheet. Okay, the balance sheet. Remember, with the balance sheet elements that you're supposed to have, you're going to use to have elements of element of assets, liability, and capital. Okay, I'm going to wrap here. You're going to still have you're going to have your name here, the name of your company or the name of your organization, for example. For our question was Mang'ana Traders, and then you have to write here, this is a balance sheet or balance sheet for the period ending or is at 31st, whatever the case, or you can even say it for the period ending. It is the same thing. For the period ending, 31st March, that March. Okay. So as I said that we are going to start by our assets, and then here it depends the assets, because we have two categories of assets. We have non-current assets and we have current assets. So let us start with the non-current assets. Non-current assets, how much or what are the non-current assets that we are having? If you go through the question, you'll see that we have the buildings there. So here you're going to have your buildings. You also have a van. I saw that we have a van. So you have to put the figures of the building. The building costed us 55,000, and we have a cost of a van that was 4,000. Do we have any other non-current assets? Yes, we have fittings there. Shop fittings. How much was shop fittings? That was 5,200. Okay. Do we have anything? Yes, we have equipment. How much was equipment there? 1,000. Okay. I'll stop here a bit and explain something. What do we mean non-current asset? Because you might even ask yourself, what do you mean non-current asset? Non-current asset, these are the assets, the long-term asset that we expect that they are going to generate future economic benefit in your company or in your organization, but it will take a longer period of time. Or these assets, you expect this asset to be staying into your company for a period more than 12 months. So for example, you have equipment. We don't expect that your equipment to stay for a period like 1 month or 2 months. It is our expectation that these assets, for example, fixtures and fittings, or the van or the buildings, we expect your building to stay for a period more than 12 months, or we expect a van to stay for a period like more than 12 months, 2 years, 3 years, up to 10 years. So all these assets or type of asset that we expect that they are going to generate economic benefit for the period more than 1 year, we're going to categorize them into non-current assets. Okay. So those are the non-current assets that we're having. You have to add them. Okay. If you add them, 55. Here it is going to be 200. This is 610. It is going to be 610. 5. 60. Okay. Because this is 1, 2. This is 6. Okay. 10, 5, 15. So it's going to be 65 and 200. Okay. So the total of non-current asset is 65, 200. That is the total of non-current assets. So that is the total of non-current assets. Again, from the non-current assets, you have to come up with the current assets. I'm going to wrap here. You have to remember that figure 65,200. That is non-current assets. Then let us see the current assets. The current asset that we are having. Elements of our current assets include cash and cash equivalent, if you have your debtors, if you have prepared expenses and so forth. Let us go to our question. Stock. I saw we have stock, and the stock here that we are going to put here, we're going to put the closing stock from the note. From the note, I remember we were given a closing stock of 1,380. So the closing stock should be here because that is the balance of the asset or stock that you are having at the end of that period. Okay, so it has to be there. It has to be reported. Again, you have your debtors. From your trial balance, you have your debtors. How much was the debtors? 150. Also, you also have amount of cash. You have money in terms of cash, and you also money in a bank form. How much do you have in a bank? In a bank, you have 5,100 and what? 5,163. But you also have cash. How much cash you are having? Very small amount. You have cash of 495. If you add this, you're going to get how much you're going to get. You're going to get if you add here, you're going to get 600. you're going to get 6,808 because this is 8. Okay, you're going to get 808. Okay, so the totals of the assets. So the totals of the asset, because in the long form here you're supposed to put the totals of the asset, which means the totals of the assets, the total of non-current assets and current asset. Non-current assets here you're getting 65 to 100, and total of current asset is 60. It is 69. It is 60. No, not 69. 6,880. If you add this one, this is 80. This is 0. This is 72. Okay. So this is the totals of the assets, or we call it total assets. Total assets are going to get 72,088. 72,088. This is the total of assets. Now the totals of assets from the accounting equation, asset equal to liabilities plus owner's equity, from the accounting equation. So the totals of the assets should be equal to the totals of liabilities and equity. The totals of the assets should be equal to the liabilities and equity. Okay. Now we have here 72,088. So we are going to compare it, because you are going to compare it with the totals of liabilities and assets. Now let us see the liabilities that we are having. The liabilities that we are having. Okay. Let us see the liabilities that we are having. Also liabilities, we have non-current liabilities and current liabilities, or long-term liabilities. Long-term liabilities and current liabilities. The long-term liabilities that we are having, these are, what do we mean by long-term liabilities? These are liabilities that we expect that they are going to stay in your company for a period more than a year. So for example, if you're having a bank loan that we expect that you're going to repay a bank loan for a period of more than a year, that is a long-term liability. So if you have debentures or sort of any other arrangement whereby you're indebted to pay for more than 1 year, that is a long-term liabilities. Now for our case, I remember you have a loan. We have a loan figure there, a loan of 1,000. So that is a long-term liabilities. Okay, long-term liability. Okay. Again, with the current liabilities, you don't have any other long-term liabilities. We have also have for current liabilities. Current liabilities, we have one element of current liabilities. We have creditors. How much was the figure of creditors? That was 2,000. Okay, 200, not 2,000. Sorry, 200. The figures for current creditors was 200. So the totals of the liabilities is, you take 1,000 plus 200 is 1,200. So this is the total of the liabilities. Now from the total of the liabilities, then you should finalize with your capital. How much capital that you are having? From our figures, we have a capital of 70,000. You've seen that from the trial balance capital, the initial capital that is in Mang'ana's trade is 70,000. Then from this capital, you add profit. How much profit? The profit that, so we are going to transfer the figure of the profit that was accrued from the income statement. Okay. Now the figures of the profit from the income statement, I remember you had 888. That was the figure of the profit, 888. Now if you take 70,000 plus 888, you're going to get 70,088. So if you take 70,088, you plus the totals of liabilities, you're going to get this is 70,000. You're going to get 70. It is going to be 8 here. 8 is going to be 0, so it is going to be 72 and 88. You see, now the totals of liabilities and capital is going to be 72, 88. If you compare to the totals of the assets, there, total assets was 72 and 88. So that is why I'm saying it is called the balance sheet, because the totals of the assets are equals to the liabilities and capital, and the sheet in itself, it is balanced. So up to that point, you've seen that that is a balance sheet. So we have seen how to prepare an income statement. We have also seen how to prepare a balance sheet. And as I've said, that is our focus today with this course OAF 101, the principles of account, because we want you to give an elemental element to be able to understand and interpret this financial statement. Okay. So you'll find also these notes into the model account. And if you find any elements, or if you find that you are having some difficulties into understanding this, write an email to me, and I'll be able to explain to you in a very short notice. Okay. I hope you've enjoyed and you've learned a lot, especially with our intention today to be able to prepare these financial statements. So just to make a summary, what we mean by financial statements, we mean the financial reports, those fives, but our concern today was the income statement, the balance sheet, and you only prepare this from the elements, or from the information that you were given into the trial balance, or from the process that you posted into the trial balance. Then you take elements from the trial balance, then you come up to prepare the income statement. Otherwise, thank you for being with me today, and I hope that you've learned a lot and will be able to practice it through the questions that you find them in the model, and you can be able to do these kind of questions. Thank you so much, and be in touch.